The safest asset in your 401k is flashing warning signals that last appeared before the collapse of the Roman economy. We're told that when the Federal Reserve cuts rates, bond yields fall. That's the textbook rule. But since September, the Fed cut rates and yields did the impossible. They went up. In the previous 7 cutting cycles going back to the 1980s, yields fell 100% of the time. This time, the market overrode the central bank. And in April, we crossed a line that shouldn't exist. For a brief moment, investors decided that lending money to the United States was riskier than lending money to Greece. This isn't just a market glitch. It's what Ray Dalio calls a debt death spiral. The Romans faced it. The British Empire faced it. And now your retirement account is facing it. Most people think this is just volatility. It's not. It's a historical cycle. And if you know the pattern, you can position yourself before the safe part of your portfolio becomes the trap. In April, the bond market proved who's really in charge. It made the president blink. April 2nd, 2025. President Trump declared Liberation Day and announced sweeping tariffs. The stock market dropped. $7 trillion in value disappeared in a week. But the real crisis wasn't in stocks. It was in bonds. 30-year Treasury yields spiked above 5%, the biggest 3-day increase since 1982. That brief moment when U.S. debt looked riskier than Greek debt? It happened right here, the president noticed. And what he did next tells you everything about who really runs the economy. Trump told reporters people were getting a little queasy and that the bond market is very tricky. 7 days after Liberation Day, he reversed course. 90-day pause on tariffs. The bond market told the president what to do, and the president listened. Whatever your politics, that should concern you. The bond market now has veto power over policy. The bond market wasn't finished. 6 weeks later, it did something that hadn't happened in over 100 years. May 16th, 2025, Moody's downgraded the United States from OLA to AA1. The rating we'd held for over 100 years, gone. But here's what matters. Moody's was the last holdout. S&P downgraded us in 2011, Fitch in 2023. Now all 3 major agencies rate America below OEA for the first time in history. Moody's explained why. Successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs. Translation. Nobody in Washington can stop spending money we don't have. The numbers behind the downgrade tell you exactly where this is heading. The national debt just crossed $38 trillion. That number is too big to feel, so here's one that isn't. The government now spends $970 billion a year just on interest payments. That's more than we spend on defense. It's 19 cents of every dollar the government collects, just to service debt we've already accumulated. And here's the trap. When interest rates rise, the government pays more interest. When the government pays more interest, it borrows more to cover the gap. When it borrows more, rates rise again. Each turn of the cycle makes the next turn worse. 5 years ago, interest payments were $345 billion. Today, they're $970 billion. They nearly tripled, not because we borrowed 3 times as much, but because rates rose on debt we already had. The man who built the largest hedge fund in history saw this coming. Ray Dalio's debt death spiral works like this. A debtor borrows money just to pay interest on previous debt. Each payment requires more borrowing. Each borrowing raises rates. The trap tightens. He says we're in one. So what did Rome actually do when they faced this trap? The Roman denarius was nearly pure silver when the empire was strong. By the time the empire fell, the denarius was less than 5% silver. The emperors didn't announce this. They didn't default. They just quietly mixed in cheaper metals year after year until the coins that soldiers earned and families saved were worth a fraction of what they'd been promised. Prices rose. Savings evaporated. The people who trusted the currency paid the price. The people who saw it coming bought land, gold, anything real. The British faced the same choice. They made the same decision. The pound was the world's reserve currency for over a century, the anchor of global trade. After 2 world wars and mounting debt, confidence eroded. The transition to the dollar took decades, but it happened. And ordinary British citizens watched their savings buy less and less as the empire's debts came due. The man who manages the most money on earth thinks America is next. Larry Fink runs BlackRock, the largest asset manager on earth. In his annual letter, he warned, the U.S. has benefited from the dollar serving as the world's reserve currency for decades, but that's not guaranteed to last forever. He said, if deficits keep growing, America risks losing that status to digital assets like Bitcoin. That's not a crypto evangelist. That's the man who manages $10 trillion. America's largest foreign creditor figured it out years ago. They've been quietly heading for the exits. China held $1.3 trillion in U.S. Treasury bonds at the peak in 2011. Today, that number is $700 billion, the lowest since 2009. They've been selling steadily for years, not in a panic, methodically. month after month. They're not the only ones. Foreign central banks around the world have slowed their Treasury purchases. The buyers who used to absorb American debt without question are asking questions now. They're repositioning, quietly reducing exposure while they still can. The question is what they see that most Americans don't. If you're watching this, you might be seeing it too. Drop a comment. What's the pattern you're noticing that others aren't? The people who manage trillions of dollars see what's coming, and they're saying it out loud. Jamie Dimon, CEO of JP Morgan Chase, said it plainly in May. You are going to see a crack in the bond market, okay? It is going to happen. I just don't know if it's going to be a crisis in 6 months or 6 years. Ray Dalio's advice, put 10 to 15% of your portfolio in gold. His logic, there won't be a default. The central bank will come in and will print the money and buy it. And that's where there's the depreciation of money. No default, just your savings quietly losing value. So what does this mean for the money you're counting on for retirement? Here's exactly how it hits your 401k. Most Americans don't think about bonds. They pick a target date fund, set their contributions, and trust the system. But target date funds, the default option in most retirement accounts, hold anywhere from 10 to 40% bonds, depending on your age. The closer you are to retirement, the more bonds you hold. The assumption is that bonds are safe. They balance out stock volatility. When stocks crash, bonds rise. That's what the textbooks say. That's what decades of experience taught us. But in April, something broke. Stocks fell, bonds fell, the dollar fell, all three at once. That pattern has a name. It's not supposed to happen here. That pattern usually only appears in emerging market crises, countries like Argentina, Turkey, nations where investors lose faith in the government's ability to manage its finances, not the United States, until now. The question isn't whether you own bonds, it's whether you understand what happens if the bond market's 40-year bull run is over, because the safe part of your portfolio might not be safe anymore. The system hasn't collapsed. But 5 things that were supposed to be impossible all happened this year. Here's what actually broke. The safe haven correlation, stocks down, bonds up, broke in April. The Fed's control over long-term rates broke when yields rose despite cuts. The AAA status broke after 100 years. The assumption that U.S. debt is the safest asset on earth broke when treasuries briefly yielded more than Greek bonds. Here's what hasn't broken. Auctions are still clearing. The dollar is still the reserve currency. There's been no default. The system is stressed, not collapsed. But the warning signs are the same ones that preceded every major currency crisis in history. And every one of those crises had the same warning period before the collapse. The British pound's decline took decades. Rome's debasement took 2 centuries. These things don't happen overnight. They happen gradually, then suddenly. The people who see it early have time to prepare. The people who don't wake up one day and wonder what happened to their savings. The bond market is the largest, most important market in the world. It prices everything, your mortgage, your car loan, your government's ability to function. When it breaks, you feel it everywhere. For the first time in modern history, it's telling us something the Federal Reserve can't override. The math is simple. $38 trillion in debt, $1 trillion a year in interest, $6 billion more every single day. The pattern is ancient. The playbook is familiar. The ending is always the same. They're running plays that are centuries old. Once you see the pattern, you can't unsee it. You can't be trapped by it. Subscribe. The history they don't teach is the history that protects